right, good morning, good afternoon, everyone. Good afternoon, good afternoon. Hopefully you've had lunch by now. It is afternoon. So we are going to get started on our cash management regulations overview. Presenting this session, we have Ashley Higgins, who is coming from OPE. We have David Musso, who I love, from policy, because he is the person I go to when you ask me questions and I don't know. And then I am Natasha Webb. I am one of the training officers from out of the New York Regional Office. So welcome to cash management regulations. And this is the part where after you have packaged your students, after you've awarded your students, now we're looking at how you're going to go about dispersing your students. And we ask the question, what is cash management? And it's basically the fiduciary responsibility of your Title IV participation. It means that you have looked at your policies, you've looked at your procedures, you've made sure everything was in order as far as accuracy when it comes to maintaining records, making disbursements, Title IV returns, everything that covers the disbursement area falls under the cash management regulations. And it's a lot of responsibility, but for your listening ear, we've broken it down into 3 parts to make it a little easier so it won't seem so harsh coming from one person. We're going to go through our presentation, all 3 parts, and then allow questions afterwards. Is that okay with everyone? Okay. Okay, I am terrible with the clicker. Me and clickers just don't get along. Okay, so as you can see from our agenda, we're covering the basics of cash management. It can incorporate so many different areas, so many concerns, but these are the basics that we will be covering in the next hour and a half or so. We are, of course, looking at policies and procedures as it relates to how you set up your own operations at your institution, looking at our payment methods, looking at the disbursement process in full from the beginning to the very end. We're going to look at the notices that are required as well as the authorizations that are required, the different types of disbursement so that you understand what early disbursement, late disbursement, what that actually means. We'll also look at the proration. That's been a big question and a big concern as far as proration and credit in the students' accounts. We're going to look at books and supplies and those arrangements that so many people had questions about, the Tier 1, Tier 2. We're going to take a look at that as well. We're going to talk about your bank accounts and, of course, a little bit about the excess interest and return of Title IV funds. So, disbursement. When we talk about disbursement, we're talking about the Title IV definition of disbursement. And the Title IV definition of disbursement is the date that the school actually credits a student's account, or you're paying a student or the parent directly, either from the funds that you're receiving from the department or funds that you have used from your own funding in advance, and then you're reimbursed by the department. So either of those can be considered disbursements according to our definition. Once you give that student the money on their account or you put it in their hand, regardless of whether it's coming straight from the department or if you're using your funds first, that is considered a Title IV disbursement. Now, although you may have verified your student eligibility from the time they came into the school to the time you awarded them to the time you were ready to process the student, you must also make sure you confirm that student's eligibility before you make the disbursement. Now, there are different types of eligibility confirmations that you will be looking at. And again, this is whether you're actually confirming the eligibility or whether your third-party servicer is confirming the eligibility, if that's what you've contracted them to do. This applies to either the school or the third-party servicer, where you're checking the eligibility of that student before you're making disbursements. You're looking at the general eligibility, looking at that student's attendance, their enrollment status, their SAP records. That's general eligibility. You're looking at program-specific eligibility. Is that student still in an eligible program? You're making sure on the e-card that there was no eligibility change in the actual program. We're looking at the period for which the student is eligible. So we're looking at the credit hours and the weeks to make sure the student's ready for the second payment period or a subsequent payment period. Okay, so those are the three eligibility areas we're looking at to make sure that a student is ready for that disbursement. So no matter how many times you've looked at student eligibility beforehand, before you actually make that disbursement, you are required to confirm that student's eligibility. So how do we go about processing a disbursement? Well, we have our COD and our G5 system. They work very closely together. Many of you already know the COD system is student-specific, whereas the G5 system is program-specific. Okay? As far as COD is concerned, we're looking at origination and disbursement records that are being submitted. We're looking at how those records are processed, accepted, edited, or even rejected within the COD system. Now, each student's date of disbursement that is entered into the COD system, that will process into the G5 system by the next day. So when we move to the G5 system, we are looking at actual funding for each of the programs. G5 consists of money that's coming in from a procurement system, which means that Treasury money for any type of program is flowing through into the G5 system. It's not just Title IV. So you have to be very careful at understanding what the codes are for the Title IV programs, for Pell, direct loan, SEOG, so on and so forth. As far as G5 is concerned, any payments that are processed by 1 p.m. of any given business day, those funds will be in your account by the next business day. So if you're gauging when you're processing in COD, when you're processing in G5, just consider that anything that's done before 1 p.m. will hit your bank account by the next business day. When it comes to actually entering COD records, anything that goes into the COD system and is accepted by 10 a.m., those funds will be in your account by the same day. Anything after 10 a.m. and before 10 p.m., they will be in your account the next morning. So you can use that as a gauge as to when you actually process in COD or if you're processing in G5 system. Now, when we talk about disbursements, we're looking at different types of payment management. The most popular, the most familiar, the one that you want to be most familiar with is the advance payment method. Now, the advance payment method allows the most freedom for drawing down your actual funds. When you draw down funds, you are drawing down, as you see that your students are eligible, you have the freedom to actually go into the system, draw down the money on your own. You can draw down prior to dispersing funds to your student on their actual accounts. That's the freedom that's given to you on the advance payment system. Okay? When you began your eligibility, you were placed on advance payment method probably, and you've continued on that. When we talk about advance payment, there are still some rules that apply. Even though we give you freedom with how you draw down those funds, there are some stipulations. And you are never allowed to draw down outside of your immediate need. Okay, you can only draw down for your immediate need. What does that mean? That means that you have 3 days to make a disbursement, or it will become excess cash. And we'll talk about excess cash a little later. Okay, so you must draw down for your immediate need, which means within 3 days, and any credit balance that occurs, and we're talking about Title IV credit balances now, any credit balance that occurs must be paid within 14 days. Okay, and these are all considerations when you're setting up your schedule on making payments to students. If you know that someone is not going to be in the office within 3 days, you probably won't make that disbursement. You will not make that drawdown from G5 until you know that you can absolutely process that draw and disperse it to a student. So again, advanced payment system is the most common, that gives you the most freedom. Then we have the heightened cash monitoring system of payment, where the institution is making the disbursement first. Before you can draw down, you have to make sure you make that disbursement. And if a Title IV credit balance occurs after you make that disbursement, you are also responsible for making sure that Title IV credit balance is paid within 14 days. You may not have the money yet, you may not have drawn down the money yet, but under heightened cash monitoring, which means that the department had a need for monitoring the school's cash flow for whatever the reason may be. It's the lightest form of monitoring, but there are still stipulations. And the main one to remember is that you are making the disbursement before you draw down the funds. But even after you make that disbursement, if a Title IV credit balance occurs, you are responsible for processing that Title IV credit balance within 14 days. So we've talked about advance, we've talked about heightened cash monitoring 1. The next level of cash monitoring is heightened cash monitoring 2, and then we also have reimbursement. Now, these are the more stricter forms of monitoring a student's cash, because not only are you dispersing the student first before drawing down, again, if there is a credit balance that occurs, you are responsible for making sure that credit balance is paid, even if you have not received the money from the department yet. Okay? So under HCM2 or reimbursement, you're first dispersing your students, you're paying the credit balances, and then you're submitting a request to receive the money from the department. The difference in submitting that request is that you have to gather your records for those particular students to show that they are eligible. You have to send those records to your regional office where you have a reimbursement analyst. That reimbursement analyst has 30 days to review those records, and then they are the ones that will go into G5 to process anything that they've approved into your bank account. Okay? The reimbursement analyst can also reject some of your students, which means you might not get exactly what you requested when you sent that information in. Once they go through the process of looking at all of your student records and making sure your students were eligible for the disbursement that you made, only then will they pay through G5 to your bank account. So as we look at the process of disbursement and funding, schools are required to substantiate any disbursements made on behalf of the Title IV eligible students. What does that mean? What is substantiation? Well, we have a school financial aid systems report where the actual disbursement that is going into COD cannot be made earlier than 7 days prior and no later than 15 days after COD has accepted the records in the G5 system. Okay? And once it's accepted, as far as COD is concerned, it goes into G5 and it will generate the funds that are available for your institution. So we're looking at no earlier than 7 days prior or no later than 15 days can COD records be accepted to be processed in G5. That's for the Pell Grant program. When we're looking at the loan program, because it's a different payment method as far as substantiating is concerned, and I'll explain that in a minute. When we look at the financial aid systems reports, you are, again, reporting the actual disbursements for direct loan no earlier than 7 days prior and no later than 15 days after COD has accepted those records. Okay? So when we're talking about substantiating the record, with Pell Grants, we're talking about a records first system. And that's where the school is submitting actual disbursement records to COD, and that's what increases your funding level. Okay? COD accepts those records, and then the G5 authorization is being increased at that point. So anytime you are drawing money down for particular students, you will always have to go back and make sure the funds that you drew down are substantiated with students. So any funds drawn down in G5 is substantiated in COD because COD is student specific. We also give you another example of the process overview, and we're looking at advanced pay schools only right now. So once the money is drawn down and you have that G5 drawdown request, deposits are received in your federal funds account. Your account must have federal funds in its name. Once they're received in your bank account, you have 3 business days to disperse. This is what we talked about a little earlier. There are different types of disbursement that you're making because you could make an early disbursement, you can make a late disbursement, you can make a post-withdrawal disbursement, you can make a retroactive disbursement. We're going to show you what each of those are in just a minute. So once you've made those disbursements, you're reporting to COD within 15 days to make sure those records are accurate. You're applying it against the institutional costs. And then that's how you determine whether there's a credit balance. You're paying that credit balance within 14 days, and you have actually completed the disbursement process by taking all of those actions that were just explained. Now, I mentioned excess cash in all the different disbursement methods, the advanced, the HCM1, HCM2, and reimbursement. Excess cash, so important that we gave it a screen all to itself. This is very important because this is looking at the fiduciary responsibility of the institution. So any amount of Title IV funds that you are receiving, and I mentioned that word immediate need, the phrase immediate need is within 3 business days. If you have disbursement money that you've drawn in, but you did not actually disperse it to the student within 3 business days, that is excess cash. And that's whether you are drawing in funds from the department or whether you have dispersed the student first and then you're drawing that money in later. Either way, if you're holding on to it for more than 3 days, it is considered excess cash. And that's not a very good thing. Why? Because this allows the department to take action to place a school on heightened cash monitoring. This is one of the major reasons schools are placed on heightened cash monitoring, because of how the funds are being used. You can be placed on HCM1, HCM2, or even reimbursement, depending on the severity of that excess cash issue. The other thing that will happen is that you will be required to reimburse the secretary for the excess amount or for any costs to the federal government of holding on to that money. So we're looking at interest that might have been held on to that you're required to pay back, along with any liabilities that you might be required to pay back. So excess cash, no. We don't want to even go into that area. So you want to make sure your systems are in place so that when you draw down money, you're ready to disperse it to the student. And that was the reason why we gave you the Title IV definition of disbursement, to make sure you're doing this in the correct manner. So in addition to knowing when and how and where you make the disbursements, there are also notifications that go along with your procedures. Prior to making any disbursement, you must send a notification to the student or the parent. And this has to be done beforehand, okay? You are notifying the student or the parent, if we're talking about loan money, of the type and the amount of federal student aid funds that's going to be received, the type and amount of funds available, how and when the disbursement will actually occur, okay? If we're looking at direct loan funds, you're also explaining whether it's subsidized, unsubsidized, or plus. You have to spell everything out to the student and or the parent, because they may not understand, what this money is. I know I'm getting loan money, but what type of loan money? Because of course the sub and unsub has different rules that follow behind it as far as interest is concerned. So you have to send those notifications prior to making the disbursement. When we talk about direct loan funds, you're also letting them know what the anticipated date is and the amount. But there's something extra that comes along with direct loan disbursements. You also have to let the students or the parents know that they have a right to cancel that loan before you're dispersing it. You also have to let them know the procedure for canceling that loan. All of this has to be in that particular notice, okay? This is all before you actually disperse your student. You have to send these notifications. And then we have authorizations as well. In addition to the notices, there are authorizations that must be obtained prior to dispersing those Title IV funds. The authorizations include using funds to pay allowable educational related charges other than the tuition fees and room and board, for crediting federal work-study wages to the student's actual account, and to hold that Title IV credit balance longer than 14 days, okay? You have to have the student or the parent's authorization to do these particular tasks. In addition to that, when it comes to holding the Title IV credit balance, if you are using store value cards or some similar instrument for transferring money back and forth to the student, that's considered under credit balance area as well, okay? So you have to have authorization if you are using a debit card or if you have some other form of transferring money to and from the student to pay them their credit balance. That has to be authorized by the student as well. Authorization, there we go. I told you I'm not good with these clickers. If you are paying up to $200 of the prior year charges with the current year's funds, you must have the authorization from the student in order to do that as well. Okay. Authorizations are valid for the entire enrollment period. Authorizations are valid for the entire enrollment period. Okay. When it comes to authorizations, you must make sure the terms are very clear, they're defined, and remember that authorizations are voluntary. You can never coerce or make a student or parent sign an authorization if they decide that they do not want to have you hold their credit balance or use their work-study wages to pay for any charges. What you do have to consider in determining authorizations, and even with the notices, is who is going to be the office that is going to maintain those authorizations. Are you going to do this electronically, or are you going to do it by paper? Okay, what is going to be your process for holding those Title IV credit balances and releasing the funds if they choose to cancel that authorization? So you want to make sure your policies and procedures will cover all the different aspects of what might happen with those authorizations, whether a student says, yes, I want it, or if they say, hey, you know what, I changed my mind. We mentioned the types of disbursements that can take place, and we have 4 here. In most instances, we're talking about a normal disbursement, and that's the disbursement that takes place within the payment period, okay? While the student is eligible, they're in your school, they're taking their classes, everything is working perfectly, you're making a disbursement within the payment period based on that student's credits or hours and weeks that are completed. But then there is another option where you can make early disbursements to students. And that's when you are dispersing for that payment period for an eligible student prior to when they actually begin attendance at your institution. The third type of disbursement is a retroactive disbursement, where you can make disbursements for a payment period made after that payment period ends. Let's say you don't get all the information that is needed, or for whatever reason, you did not receive the money from G5 until the next payment period. So under a normal circumstance, you would be ready for that second disbursement, but you never made the first disbursement. You can retroactively pay that student. Okay, and this applies in many circumstances, even when it comes down to eligibility of the institution. And then we have late disbursements, and this has come up a lot with our students who are back and forth, because what happens when a student is no longer eligible at your institution? Does it mean that the money that you processed for them and show that they were eligible for while they were in school, that they won't get that? No. They can still receive that money. So even after a student is no longer eligible, once they've ceased enrollment, once they've graduated, you can still make a late disbursement for that institution as long as you have a valid EFC, you have a valid origination record, master promissory note. You are allowed to make a late disbursement even though the student is no longer in attendance at your institution. So these are the different types of disbursements that can be made on behalf of students. There are some restrictions when we look at direct loan disbursements. The first one is that when you make a first disbursement to a first-time, first-year undergraduate underborrower, you must delay that disbursement for 30 days after the start of class. The only exception to that is if your institution meets the low cohort default rate exemption, which is 15% for the most 3 recent years. If you do not have a cohort default rate that is lower than 15% for the last 3 cohort default years, you must make sure you delay disbursement of direct loan for first time, first year, first disbursements for those particular students. Okay. Also, when direct loan is made for one payment period, let's say you have a one-term loan, you are still required to disperse that loan in 2 equal payments. Okay. The only exception, again, is if you have that low cohort default rate for the 3 most recent years. Okay, so these are the restrictions on the direct loan funds that you have to keep in mind as well. Now, we're not going to deal with modules. If you were here for the last session, you caught the entire module session. We're not going to talk about that. But, of course, modules and disbursements go hand in hand. So when you have a student who is enrolled in a module program within a payment period, that student is considered enrolled for the entire payment period. Okay? So when we talk about loan periods, that loan period includes the entire payment period. But when we talk about the cost of attendance, it excludes the periods of non-attendance, which means it's only looking at the time of that actual module. Okay? Modules become a little more intense when it comes to making disbursements. So you have to look at your policies and procedures for setting up your module disbursements as well. You can make a single disbursement based on that student's enrollment status for that entire term if we're talking about modules. Okay, completely opposite from what I said on the last slide if you're in a regular standard term. Yeah. If you are talking about a module program, you can also schedule multiple disbursements throughout a payment period, as long as it does not exceed the permitted amount. Okay, so this only applies to module situations, which might be a little different from your standard classes or standard payment periods. Okay, we're going to move on, and I'm going to pass the mic over to David to pick up with early disbursements.
All right, thanks, Natasha. Yeah, so I'm going to talk about a number of the sort of special disbursements that Natasha just mentioned. The first one I'm going to talk about are early disbursements. So the earliest an institution may disburse funds for any given payment period differs depending on the type of program. If you've got a credit hour program in which the terms are substantially equal, the earliest you can make a disbursement for that period is 10 days before the first day of class in that period. But there's an exception to that, and it's again a case where if you are offering a program offered in modules, then you have some extra considerations. In a module environment, the earliest time that you can make a disbursement to a given student is 10 days before that student's class start date. So keep that in mind if you've got, for example, a summer term that's comprised of several modules, or you have modules elsewhere in your program. You can't disperse those funds until the student, 10 days before the student is actually going to start class. For other programs, non-term programs, or credit hour non-standard term programs with terms that are not substantially equal, there's an additional consideration. So it's the later of 10 days before the first day of the class in the payment period, or the date that the student completes the prior payment period for which Title IV aid was received. And really by this is what we mean is, in non-term programs, you need to ensure that students complete half of the hours and half of the weeks in the academic year before they enter a new payment period and become eligible for aid in that subsequent payment period. So even though we have early disbursement flexibility for most students, if your student still hasn't completed all of what he or she needed to complete for the prior period, you got to wait until that student completes those weeks and hours before you can make a disbursement in one of those programs. So there are some considerations for direct loan disbursements that are made early. An institution that disperses direct loan funds up to 10 days prior to enrollment, to the enrollment start date, needs to ensure that at the time of the disbursement, the student is still scheduled to attend at least half-time. So this goes back to what Natasha was saying about checking eligibility at the time of disbursement. At the time that you disperse, you need to ensure that the student, he or she, is actually still enrolled, because the student may have changed his or her plans since the last time that you've looked at them and made your awards. If a student begins attendance as less than half-time and you've already made the disbursement, and when you made the disbursement, the student was scheduled to attend at least half-time, that disbursement remains eligible. You don't send that money back just because the student only began attendance as a less than half-time student. However, subsequent direct loan disbursements within the term can't be made. Some schools make multiple disbursements within the same term unless the student reestablishes half-time status. So you got to be sure that half-time requirement is met if you're going to make another disbursement of direct loan funds in that same payment period. So you guys probably all know this, but when you make an early disbursement, there's some really important considerations that you have to make about the consequences of doing that, especially if a student does not attend as scheduled. So if you disperse Pell, an Iraq-Afghanistan service grant, or a TEACH grant, and the student begins some but not all classes, you're going to have to recalculate those disbursements based on the courses that the student actually attended. So let's say that you had intended the student to attend full-time, the student fully planned to do that, but the student ultimately only attends enough courses to make him or her half-time. You're going to have to reduce the amount of those disbursements to the half-time level. And in those cases, it is the student that's responsible for returning the ineligible portion of the grant funds. And there's a variety of ways that you can handle that. I believe that there are a couple of other sessions that talk about overpayments, but this is essentially an overpayment that the student is responsible for in these cases. Now, there's also cases where you make an early disbursement and then the student doesn't attend any classes. So these are cases that are handled by a certain part of our regulations, 34 CFR 668.21. And in this case, you have to return all grant aid. So it doesn't matter whether it went to the school or to the student. You got to return all the grant aid that the student got. Any direct loan funds that you credited directly to the student's account, you've got to return those in full. If you disperse direct loan funds directly to the student, you can either choose to return those funds on the student's behalf and have them owe you, or you can notify the direct loan servicer so that they can send a 30-day demand letter, and that student will have to immediately repay the full amount of that the disbursement, which is going to be very bad for that student, and is going to be tough for everyone involved. Now, this is just something that you take on as a risk when you make an early disbursement before the beginning of a payment period. If that student doesn't show up, and you do have to find a way to make sure that you document that he or she actually attended one day in that payment period, then all of these consequences may apply. But there may be very good reasons for you to make an early disbursement anyway to ensure that students have the aid that they need, for example, to purchase books and supplies, to just get all of that out of the way and make sure that their accounts have enough aid to pay for their charges. But it's just something that we want you guys to remember when you make an early disbursement, that there could be very substantial consequences if the student doesn't actually attend. So now I want to talk a little bit about retroactive disbursements. So this is another kind of special disbursement, and as Natasha said, a retroactive disbursement occurs when you make a disbursement to an eligible student, but for a period that has already passed. Sometimes it just happens because for a variety of reasons, just can't get the disbursement into the student's hands at the time the payment period was happening. An ISER wasn't available, there was some other administrative delay, verification not yet completed, and you choose not to make an interim disbursement. All of those things could happen and cause you to have to delay a disbursement to a student who's otherwise eligible and still attending. If you're unable to make a disbursement to an enrolled student for a completed payment period, you can make a retroactive disbursement. There are some considerations for those kinds of disbursements, but there are not that many restrictions on these as there are for late disbursements, which we'll explain in a second. The one thing that you should remember, and I'll explain this in just a few minutes, is that you have to look at only coursework completed when determining enrollment status for Pell and Teach grants, and as well for whether a student was at least half-time for direct loan purposes. So the last type of disbursement we're going to talk about is called a late disbursement. Now, generally, an otherwise eligible student becomes ineligible in two ways. For direct loans, they become ineligible on the date when they are no longer enrolled at least half-time for the period for which the loan was intended. So that either means that they're no longer enrolled half-time in a given term during the loan period, or the loan period ends. In both of those cases, that student ceases to be eligible for that loan period, and any disbursement you make for that loan period after that is a late disbursement. So one of the things that we often get questions about is whether or not something is a late disbursement. Let's say a student is still attending in a subsequent year, but you want to make a disbursement back in the prior year. Is that really a late disbursement if the student is still attending your college? And in some cases, the answer is yes, because the period for which you're making the disbursement has ended. And so that's how it works with loans. For grants, the student becomes ineligible on the date that the student is no longer enrolled at the school for the award year. So for both of those, if you withdraw, obviously the withdrawal date is the date that you cease to be eligible. But for grants, it also could be the last date of the last payment period in the award year. So if spring is your last payment period in the award year, it would be the last day of spring. It's the last date that you're eligible for that grant. Or if you have a crossover period, crosses over July 1st, then it's the last date of the payment period that crosses over July 1st. So that could be August 1st, August 15th, September 1st, whatever the last date of that payment period is. But on that date, the student will become ineligible for those funds from that prior award year, even if they're still attending in a subsequent award year. But if certain conditions are met, those students could still be considered for a disbursement after they become eligible, and these are called late disbursements. So there are a few important things to remember in general about late disbursements. The first thing is that they're only intended to be used for educational expenses that were incurred while the student was enrolled and eligible. It's not supposed to be used for expenses that are happening afterwards, if for whatever reason, for whatever the student is doing after they cease to be eligible. And that includes for periods, with one exception for prior year charges in a very limited amount. These late disbursements are intended to be for the actual disbursements for the period that you're dispersing for. The second thing to remember is that there's a hard deadline on late disbursements. You can make them no later than 180 days after the student becomes ineligible. And then remember, as I said, the date that the student becomes ineligible can vary depending on the circumstances. For withdrawals, it's really easy. 180 days after the withdrawal date. That's the latest date that you can make a late disbursement for that student. And for other students, you may have to look a little bit more carefully about when they became ineligible for the specific type of aid that you're looking at. Third, if the student actually completed the period and you're making the disbursement, you must provide the student the choice as to whether they want to receive the late disbursement. So this is a particular requirement that applies for a student who's actually completed a period. You just need to offer the student the choice, and we even have said that the choice could be as simple as an email that states that the student will or will not receive the disbursement if the student does not respond to the school. So you could simply make it a statement that, you know, we're giving you this option. If you don't respond, we're going to take X or Y action. But you do have to explain that to the student, and you have to give them that choice as under the regulations in 34 CFR 668.164. If the student did not complete the period, generally, we're talking about a return of Title IV situation, and that's called a post-withdrawal disbursement. So that's a very specific kind of late disbursement that has its own rules attached to it. And those are explained in 668.22, and if you want more information, you can come to the R2T4 sessions that are being held, and we can explain a little bit more about how those work. So there are specific conditions for late disbursements. For all late disbursements, the department has to process a SAR or an ICER with an official EFC before the student became ineligible. And remember that date could vary depending on the circumstances. And then remember also that this condition that we're talking about is not a valid ICER. This is just that they had an official EFC before the student became ineligible. Later on, when you actually have to make the disbursement, you still need that valid ICER. But this condition is about the fact that they actually had just any non-rejected ICER before they lost eligibility. For direct loans and teach, the school also has to have originated the record before the student became ineligible. And for FSEOG, you have to have made the award to the student before he or she became ineligible. All of those are requirements for late disbursements. And then there are a whole slew of restrictions on late disbursements that we have. You can't make a late second or subsequent disbursement of direct loan funds unless the student graduated or completed the period. You can't, and as we mentioned before, you can't make a late disbursement of direct loan funds if the student didn't make the 30-day requirement, if they were a first-time, first-year borrower, unless the default rate waiver requirement is met. You can't make a late disbursement of Title IV funds if a student didn't have that valid SAR and ICER by the department's deadline date. So again, remember, as I said before, one of the conditions for making a late disbursement is that they had to have an EFC, an official EFC, before they lost eligibility, but you have to have a valid ICER before you can actually make the disbursement. So they need to get all of the materials to you, and you need to make sure that you've got that valid ICER by the time that you want to actually make the disbursement. And the last one is the one I mentioned before. You can't make a late disbursement more than 180 days after the student became ineligible. So that's that hard deadline that I mentioned. Some other considerations for direct loan funds. If a student didn't withdraw but ceased to be enrolled at least half-time prior to your disbursement, you can make a late disbursement of direct loan funds, but the school must have previously confirmed that the student was enrolled at least half-time at the start of the term. If you choose to do this, the late disbursement cannot exceed the educational costs incurred for the period of instruction during which the student was enrolled half-time. So something to keep in mind. All right, now, this is an important piece that I want to mention for both retroactive and late disbursements, and this is what we were talking about before with completed coursework. When you're making a retroactive or late disbursement of Pell Grant, and I didn't include this, but also Teach Grant funds, you must base that disbursement on enrollment status that was according to work that was actually completed. And that includes both earned Fs, and it includes all of the courses for which the student has passing grades. It does not include dropped courses. So if a student dropped out of a course in the middle, you do not count that for purposes of determining enrollment status for a completed period. And the reason for this is that the department now, at that point, you now know exactly what the student attended. There's no question about it by the time that you're making this disbursement, so the department wants you to rely on the information that you have about what the student actually completed. And as I mentioned, it includes earned Fs. There's a very lengthy discussion of earned Fs in the FSA handbook, but in case you don't know what that means, it just means that in your grading policy, you differentiate between a course that the student completed but failed to complete course objectives, and a course that the student dropped out of and didn't complete. So if you have a grading policy that differentiates between, for example, Fs, where they completed the course but failed, and Ws, where they didn't even complete the course, then you can use those Fs to calculate enrollment status. A school that makes retroactive or late disbursements of direct loan funds also has to base the calculation of enrollment status for that period according to work already completed. So you have to have a completed either an earned F or a passing grade for at least half time in order to provide that late or retroactive disbursement of direct loan funds. All right. Now I'm going to turn to a topic that's been probably, I would say, a little hotter in the department's area recently. We've gotten a lot of questions about this. These are some requirements that they were long-standing requirements, but we actually put them into regulation in the 2015 regulatory process that went into effect in 2016. And this is about when you can credit a student's account with Title IV aid as opposed to providing the aid directly to the student. So, you can credit an institution's account with Title IV aid to pay for what we call allowable charges. And allowable charges is the framework that the department created to determine whether something is something that you can put on the student's account or whether you have to provide it to the student. Allowable charges include things like tuition, fees, and institutionally provided room and board. And it also includes books, supplies, and other educationally related goods and services provided by the institution if the institution has obtained authorization from the student for those books and supplies. So it's important for the school to have that authorization in hand, and Natasha talked about those authorizations a little bit earlier. One thing I want to say about this bullet is really referring to books and supplies that are not treated as institutional charges. There are some cases where schools incorporate books and supplies into their tuition and fees, and Ashley's going to talk a little bit about the requirements for doing that in a few minutes. But really what we're talking about here are books and supplies that the student has a real and reasonable opportunity to get elsewhere, and that the school is allowing them to give an authorization to pay for. And those are all allowable charges that you can apply Title IV aid to their account to cover. Now, allowable charges also include what we call prior year charges. A school can credit to a student's account for up to $200 in prior year charges. And in the regulations in 2016, we expressed much more clearly what a prior year charge is. And we said a prior year charge is a charge that occurred in a year prior to the current year, and we actually explained what the current year is in much more detail. The current year is, and it depends on the program, if you're only getting a direct loan, it's the current loan period. So if there was a charge that was for a period before that, that's a prior year charge. For a student who does not receive a direct loan but receives funds from another Title IV program, it's the current award year. So again, a prior year charge would be for anything before the award year. And finally, if you get both kinds of aid, either the current loan period or the current award year at the school's discretion, and whichever one you choose, any charge that occurred before that will be a prior year charge. That's how you identify prior year charges, and it's important that you do that because you need to ensure that you don't credit a student's account for more than $200 in prior year charges. That's for current aid. You got to be sure that you limit that, because otherwise that money has to go directly to the student. All right, and now another important concept that I want to talk about is our Title IV credit balances. So basically, if you credit a student's account and there's an overage, you need to ensure that you provide that overage to the student within 14 days. The first thing that you have to know is what is a Title IV credit balance? And this is surprisingly something that we get a lot of questions about, and I guess I shouldn't say surprisingly because it's not always intuitive, but we've actually provided an example here as to how this works. So a Title IV credit balance is, the definition is pretty straightforward. It's any time that the Title IV funds credited to a student's account exceed the total allowable charges assessed by the institution. So in this case, you've got institutional charges of $3,000, and let's assume that those are all allowable charges. Now you've got credits to the account. The total amount of credits that you have to the student's account is $6,172 in this example. That's comprised of a $1,900 Pell disbursement, a $3,272 direct loan disbursement, and then also a $1,000 non-Title IV scholarship. When you add all of that up, the Title IV credit balance is $2,172. And for those of you who are better than me at math, that's you might be going, well, wait, that doesn't make any sense. It's $3,172. But that's because there's a scholarship in there that is not Title IV aid. The Title IV credit balance, the balance that has all of these requirements around it, for example, for making the payment within 14 days, is only the difference between the total Title IV aid and the institutional charges, and that's only $2,172. Obviously, we at the department feel it's a best practice to provide a student with his or her full credit balance, but that's not one of our requirements. Our requirements are restricted to Title IV aid and how you handle those funds. So if you don't have an authorization to hold a student's credit balance, you must pay the credit balance to the student or parent no later than 14 days after the balance occurs, if it's within the payment period, or 14 days after the first day of classes if you've made an early disbursement. And as you see the note here, you don't have to pay credit balances below $1. That's a pretty low de minimis threshold. So as we mentioned before, you can hold a student or parent's Title IV credit balance with the appropriate authorization until the end of the year, and that means the end of the award year for grants or the end of the academic year for loans. But there are some requirements. The student or parent may voluntarily authorize the school to hold a credit balance, and a school must identify the amount of funds held for each student in the subsidiary ledger account, and you have to maintain cash that's equal to the credit balances held. So even though you might have an authorization for students, we, the department, expect you to have those funds on hand just in case maybe the student revokes his or her authorization. We expect you guys to have all of that money available just in case. Remember that once you've made a disbursement to a student, that is the institution's money. Now, you may have to provide some of it to the student as a credit balance, but if you've been granted the authority to hold the credit balance, that is technically the school's money at that point. So it's not subject to the $500 limitation on interest accrual that applies to the money that's in your federal funds account. This is not talking about money that's in your federal funds account. This is talking about money that is in the student's account and is part of your operating account. All right, so then I want to talk about disbursement by payment period. So this is a really important concept. It's a simple concept, but it actually it's sort of the basis for all the stuff I'm about to talk about related to proration. So except for work study, Title IV disbursements are made on a payment period basis. All of you know that. Schools can make prior year, late, or retroactive disbursements during a payment period as long as the student was enrolled and eligible during the prior payment period. But if you charge for a period other than the payment period, then you have to prorate the amount of allowable charges that will determine how much you can credit to the student's account without an explicit authorization from a student to do otherwise. And when you do proration, you have to do it in one of two ways. The simpler way is if all of the payment periods for which the charge is assessed are substantially equal, you just divide the charge over all those payment periods, right? It's very simple. So if you charge for one whole academic year, let's say you charge $10,000 for the whole academic year up front, then when you're determining the amount that you can credit to the student's account as opposed to the amount you need to provide to the student, you'll just divide it equally between the two terms, $5,000 for fall, $5,000 for spring. That's very straightforward. However, if the payment periods for which the charge is assessed are not substantially equal, then it's a more complicated process. For this, you divide the number of credit or clock hours in the payment period that you're looking at by the total number of credit or clock hours in the period for which the charge is assessed, and then multiply that result by the amount of the charge. Basically, what we're doing here is doing a pro rata calculation for the length of the payment period that you're looking at to determine the allowable charges. So that's a little bit more complicated, but this is something that you'll have to pay attention to if you charge for things that exceed the payment period time frame. If you only charge by payment period, you won't have to worry about any of this, and it makes things a lot simpler. So I created an example here for how the proration for a payment period works. And this is the simplest version, so it's obviously not going to get into the nuances of payment periods that are of different lengths and they're not substantially equal. But in this example, a school charges $4,000 in the fall for the whole academic year, and that charge is divided essentially in half between the two terms because the two terms are substantially equal, just as I mentioned before. The student then receives a $2,500 Pell disbursement for the fall term, and you can see that in the blue box there in the lower left-hand corner. Because the prorated charge, so remember, this is the prorated allowable charge, is only $2,000, that's all that you can credit the student's account without having to do a credit balance back to the student. So if you got a $2,500 Pell Grant in this circumstance, that exceeds your allowable charge by $2,000, so you need to provide the student with a credit balance refund of $500 for the fall term. And the same thing would apply in the winter term if the student got another $2,500 Pell Grant disbursement. Now, we've gotten a lot of questions recently about books and supplies. So there's a big question. In many cases, books and supplies are provided just for the payment period where the student is attending. So, you're taking a fall class and you get books for the fall. That's very straightforward, and obviously that's only intended for one payment period, so there's no proration required there. However, there are some programs and some schools that charge for books and supplies for a period longer than a payment period. Let's say you have a kit that is part of a program that's one academic year in length. In that case, the books and supplies cover more than one payment period. Now, if the books and supplies are not institutional charges, then even then, you can still charge for them up front. If the student has a real and reasonable opportunity to purchase those elsewhere, they can do that, and you can charge for them only in that payment period. However, if the books and supplies are considered institutional charges, they are considered part of the student's tuition and fees, and then you have to prorate those charges over the entire period for which they're intended. Now, one of our long-standing pieces of guidance is that books and supplies are institutional charges if a student doesn't have what we call a real and reasonable opportunity to purchase the materials elsewhere. And what we mean by that is they don't have the ability to get those materials from a relatively convenient, unaffiliated source. So if you, the institution, have your own bookstore and you don't have, the books aren't purchasable anywhere else, then the student really has no real and reasonable opportunity to get those materials elsewhere. And those are considered institutional charges. Number one, you'll have to prorate those charges if they're intended for more than one payment period. And number two, they'll be subject to all the requirements that Ashley is going to explain in just a moment for books and supplies that are part of tuition. The other time that we consider a student not to have a real and reasonable opportunity to purchase the books elsewhere is if you include a requirement in your enrollment agreement, including an addendum, that the materials have to be purchased from the school. Anytime that those things are in an enrollment agreement, we consider the student not to have an opportunity to get them elsewhere. With that, I'm going to turn it over to Ashley to talk more about books and supplies.
All right, thanks, David. Can you all hear me? Great. So I know we have a limited time left, and I do want to try and leave some time for questions, so I'm going to fly through this. But if you have questions about anything I'm about to talk about after the presentation, I'll be hanging out there, and you can ask me. So moving ahead, hopefully. All right. So if you're including your books and supplies in tuitions and fees, that's allowable. If you are providing them to students at prices that are below competitive market rates, I'll talk about what that means in a minute. If you're providing a way for them to get them by the 7th day of the payment period, and you have a policy permitting your students to opt out. When you're determining whether your books and supplies are below market rates, make sure to document that you did the research and have that available if you are subject to a program review later. So make sure that you're going online, researching costs, and that you are providing those materials at a rate that is lower than what you've seen. It's also allowable if those books and supplies aren't available elsewhere, or if you can document a compelling health and safety reason. So think medical supplies, safety equipment, those are the two exemptions to this rule. So I'm going to spend a little bit more time talking about credit balance delivery. The 2015 regs that were published have what's called a Tier 1 or a Tier 2 arrangement. So the first and most stringent requirements apply to a Tier 1 arrangement, and if you're using a third-party servicer to deliver aid to a student and under a contract, and you're communicating information directly to students about an account that an entity offers, you likely have a Tier 1 relationship, and you're going to have restrictions such as fee restrictions and other requirements that apply to those accounts. In a Tier 2 arrangement, an institution has a contract with a financial institution where financial accounts are offered and marketed directly to students enrolled at the institution. Marketed directly for our purposes means things like if you have a co-branded card that is marketed principally to students, or if you have a student ID that can also function as a debit card for this account. If you don't think you're marketing these accounts directly to students, make sure that you're retaining the contract with your financial services provider that establishes this. As a plot twist a little bit later, Tier 2 actually has 2 tiers, and we'll be talking about what that means in a minute. So under 668-164F, we have, E or D, we have the student choice menu. We will call it the student choice menu. What this means is when your students are selecting a way to receive their credit balance, their bank account, first of all, has to be the first and most prominent option. In addition, there's no pre-checking selections, and you have to ensure that the delivery to a student's bank account is as timely or no more onerous. What that means is this is addressing a concern that we saw during negotiated rulemaking, where institutions or financial services providers would have their account listed as the most prominent option, and they would say that you could get your delivery of your credit balance within a few days. But if you wanted it delivered to your bank account, then you would have to fax in a form, and it would create this artificial delay that's banned under our regs. We don't require institutions to put paper checks as an option. That's fine, but you still have to abide by the 14-day credit balance delivery requirements that we were discussing earlier. So after 14 days, you do have to make sure that the money makes it to the student somehow, even if they don't make a selection on the student choice menu. A few other requirements. You can provide for the benefit of the student other accounts that are available, other than those that are Tier 1 and Tier 2, as long as they have deposit insurance under NACUA or the FDIC. And we also say that that institutions must list and identify the major features and commonly assessed fees associated with each account offered under the arrangements. The format requirements that we've laid out were published in a Federal Register notice last year. And if you use that format, you're in compliance with these requirements. However, we do like to point out that it's not a requirement to use our format. You can use something else. And one thing that we note that might be appropriate is the Pew Charitable Trust forms that they've released recently as well. Finally, you have to have a URL on the student choice menu that gives the terms and conditions of each account. So we were also concerned with the lack of transparency around some of the arrangements, so there are additional disclosures regarding actual contracts. So all institutions with Tier 1 and Tier 2 relationships must disclose the contract between the institution and financial account provider on their website and send the URL where the contract is located to us. So that's all Tier 1 and Tier 2 relationships. If you're Tier 1 or you're a Tier 2 relationship that meets the thresholds that are on the slide, then you have to go a little bit further and you have to send us the mean and median you have to have the mean and median costs that the students incur, the number of accounts, and the total monetary consideration paid or received and non-monetary consideration. We say in the regs that this has to be in a format provided by the secretary. That was released in an EA last year. Essentially, if you meet these requirements, when you click on that URL, the first thing I would need to see would be the mean and median costs, followed by monetary consideration, then non-monetary consideration, then your full contract. So after all that's done, you send the URL to us, and we publish it in a centralized database. You can see the contract data on the web address that's on the slide. ATMs. If you are a Tier 1 provider or a Tier 2 that meets the threshold requirements, you must have ATMs that are sufficient in number and must be housed in service so that Title IV funds are reasonably available to students and they can get their credit balance. And if I put you to sleep at this point, I'm sorry, but you have to wake up for this part because this is new. In the vast majority of cases, having funds that are reasonably available to students means having an ATM on campus. This is something that that our program compliance divisions have been coming across. There are a few examples that are on the slide where that might not be appropriate, but in the vast majority of cases, this means having an ATM on campus. So there's one other thing that I don't have a slide on, but this seems like a good time to bring it up. But for Tier 1 arrangements, there is a requirement, and this is something that we've been talking about with program compliance as well, that students have to be able to access their full credit balance without fees. We don't say what the way is, but there has to be a way. But in our talks with program compliance, we've found that we're starting to see a few restrictions, not just daily ATM limits, which aren't that concerning, but in the full context where we're starting to see limits on the amounts that can be withdrawn from tellers, daily transaction limits, or fees transferring funds to another bank account. It's starting to look like there really isn't a way in a lot of cases for students to access their full credit balance without a fee. So make sure that that's not happening on your campus, please. This one's pretty straightforward. New contracts and modifications must not harm students. If your contract meets the thresholds we discussed when we were talking earlier, then this would apply to you. I have no idea what just happened.
That's strange.
Well, while David fixes that, I'll talk a little bit more about best interests of the students. Thanks, David. A school must document under best interests of the students that you've reviewed your contract and that the fees under that contract are consistent with or below market rates. And you have to ensure that the contract can be terminated due to complaints or excessive fees. Thank you. So, bank accounts. Make sure that when you're receiving Title IV funds that they are in an interest-bearing account unless you, we're at 5 minutes now, so I'm just going to say, unless you meet one of the exemptions on the slide, this is going to apply to you. For a domestic school, the depository account has to be insured by the FDC or NCUA. We know that the limits in those accounts are probably not going to be quite as much as what's in them. This is more relates to the regulatory requirements for an account to be insured under these entities. So when you're establishing these accounts, file a UCC-1 with the appropriate government entity and include in the name of each depository account that pays federal funds, or notify the depository institution that the account holds Title IV program funds and retain a record of that notice. As I'm sure everyone's aware, you can retain up to $500 in interest on funds, but you can't on a depository account, but you can't engage in any practice that risks the loss of those funds. Nothing prevents you from sweeping your own funds, but ensure that Title IV funds aren't part of any sweeps. I'm going to skip over this part. And I'm just going to go ahead and talk about returning the excess interest. This did change a few years ago, so I want to make sure we touch on this. Excess Title IV interest is now being returned through the HHS payment system. There's an EA from May 19th, 2017 on this, and it explains how to go through this process, but this did change as a result of OMB guidance a few years ago. I think we have about 4 minutes for questions, so if anyone has some, please go ahead. Yep.
All right, and so if anyone has questions, come on up to the microphone here in the center. I know that there's a couple of them in these rows. There's actually 3, and we'll be happy to answer your questions. And if you have something that you don't want to have the whole group talk about, you can come on up and talk to us after the session's over. All right, we'll start over here.
Good afternoon. My name is Leslie Lloyd, and I'm with Craven Community College. I think back on slide 11 or 12, you were talking about the notification that we need to send to our students before a disbursement.
Yes.
So we only do Pell, Federal Work Study, and FSEOG. So are we still required to send out a notification of disbursement and all that particular language prior to making a disbursement?
So you're required to send out a notification, but you aren't required to include all of those aspects in that second bullet, and we'll go back to it
Okay.
as fast as I can. But you're not required to include necessarily all the information about, for example, there's no cancellation. I think it was, the procedure to cancel, anything like that. You just need to explain to the student how much the disbursement is going to be, how much they can expect, and then how and when they're going to get the money. Those are important things to explain because it helps the student understand when they're going to get their, for example, if they're going to have money to pay for books and supplies, or when they're going to get their money to pay their student accounts. But so you do have to do those things. You don't have to give all of the exact information that you have, for example, about cancellation related to direct loans or teach.
Now, does this need to be a separate communication, or can this be something that we wrap into? Because, you know, we send out a few communications, especially about the award letter and different things like that. So can we wrap it into something that we're already sending out, or does it have to be something specific?
No, it doesn't have to be separate as long as you make the notification in some way, and you can't make a blanket notification if it doesn't explain to us if there's differences between students. But yeah, as long as all of it is the same and you can expect the same time frame, then yes, you could put it in, include it within other kinds of notifications. It doesn't have to be separate for those programs.
Thank you.
The loan ones tend to need to be separate because those are about how you cancel the loan, and you can't just lump those in with other kinds of notifications. All right. Other questions? All right. Well, if not, thanks so much, everybody. We appreciate you coming by.